care how good you are in anything, you don't have discipline, you ain't nobody.
Right.
You're nothing without discipline. Because you give up on the slightest struggle without discipline. Discipline is doing what you hate to do, but do it like you love it.
Do you have a confirmation bias? Is this holding back your trading? Do you seek out gurus to tell you what you should and shouldn't do with the market? How you should put on trades, and then that doesn't work out either, and then you blame the guru and jump to the next one? Do you ever just want to learn how to trade for yourself and think for yourself? If so, this video is for you. We have a group of traders on our Substack page if you're looking for an awesome group to be a part of, where we do monthly Q&As. You can jump into our Substack group and come on once a month and ask us all the questions you want. Here we are filming it and figuring out how to answer those questions and a little bit about how I trade and what I do as a person who's a fund manager and also a successful trader for many years. All right, guys. Hope you enjoy.
Annual estimates. N is for new. S is for supply and demand. I feel I've like memorized it to the point that I don't really know what all of them stand for anymore. Institutional sponsorship. M is market. What is yeah. But he has a book out there, How to Make Money in Stocks. It's like there's like 4 or 5 editions at this point. It should be like on everyone's bookshelf if you take the market seriously. I think even if you don't trade his style, I think just the book alone has like 100 historical charts of the greatest stock market winners. So if you learn nothing, if you don't take away anything, like that alone is worth a lot. But you wouldn't, so the reason you would use that strategy, in my point of view, is it's based on history and not like opinion, because it's based off of the greatest winners of all time.
No, I love that. And yeah, I couldn't remember that off the top of my head either, but it's current quarterly earnings, then annual earnings, then new product, service, or management. Then it's S is supply and demand. L is leaders or laggards. I is institutional ownership, and M is market direction. So, the two parts of it that I really use in my everyday trading are the relative strength. He talks a lot about relative strength and how people really enjoy buying the losers because in general, like we're all kind of people who go like, hey, like when I go to a store, I'm not like, hey, the best banana costs $30, so I want to buy the $30 banana. That sounds ridiculous. So what we do as traders, we look at that the same way where we go, okay, well, for example, right now, I'm sure there's a commodity out there that somebody can name. I can't think of it off the top of my head, but there's some commodity that's worth really cheap right now, or stock that's all the way at the bottom of the chart, and everybody's going, man, I want to buy that one. But usually cheap continues to get cheaper, and things that are, there's a reason why people are buying something. It's kind of the same as saying like, hey, like I don't know exactly why the top 7 stocks are doing so good today. But I don't make money knowing why something is doing well. I make more money by being like, hey, I'm going to ride that trend. Hey, when the trend ends, I'm going to get out. Yes, things that are cheap can always get cheaper. And yes, at some point, there might be a time to buy those, but you want to be waiting. He talks a lot about new highs. He talks a lot about institutional ownership, meaning in the insiders, traders. I mean, he had a bunch of really cool stuff in his book, and I would definitely recommend reading it too. And the biggest thing that I learned from it was that you have a guy that really came out there and kind of had his own plan and his own strategy and continued to kind of build on that over and over again. He had Investors Business Daily, I think, was his. He wrote a bunch of books, How to Make Money in Stocks, being one of the best ones. But man, he had a bunch of really cool stuff. But I think the thing that you see over and over again with all these traders is it's mainly a thing where they have a plan and they really stick to that plan.
Yeah, and kind of doing the due diligence of like looking at history and you know they say like the stock it's like things don't repeat themselves, they just often rhyme, whereas
Yes.
market stocks, so he's a big proponent of that.
Yes. Hey, what's up, Kishop?
Hey Jason,
How are
sorry
you?
I'm late.
Oh, no problem. I
Good.
mean, you're in trouble. You're actually you're fined. You owe me a couple thousand. It's fucked up. I can't believe you're late. Today I kind of wanted it to be like, hey, I'm gonna be here because the last couple times people have had trouble getting on or whatnot. And so this time I just kind of wanted to make it so, hey, I'm gonna be here from 1:15 to 3 o'clock. People can jump in, jump out, whatever. And so we can kind of get to everybody. And I wanted to give people a chance to like ask some questions, give me some feedback how their trading's been doing most importantly, because really, like, I don't believe that, listening to someone like me is going to make you a perfect trader. I think that you have to build your own strategy and your own plan. And listening to someone like me, I can show you what I'm doing. You can model after that, build your own strategy and plan. Just like we're talking about earlier, you have a trader who's very inspired by William O'Neill, and then he creates plans and strategies based on him. But I'm sure, and I'll ask you this, does your plan sometimes change from William O'Neill's? Is your strategy a little bit different in certain ways?
Yeah, so I think as I mature as I guess investor trader, kind of learn from my own mistakes. A lot of it is also emotional, like things that worked for others won't work for me. So it's not so much about copying, it's like you start from kind of what they built out, and then through your mistakes you learn what needs to change in kind of your own strategy and kind of make it your own. So that's definitely happened the last few years. Yeah.
No, that's cool. And I mean, that's really like for me, I really like Trader Vic, but we differ in a lot of ways. He looks for a lot of reversals. I look for a lot of trends. Like, his but I think the thing that's always you'll hear over and over again, and I like how you said emotional, like it's emotional. It's not something where I could say, hey, like my strategy works very well because of my tolerance for pain. Like, for example, I'm very long term. I can hold like this cocoa trend, as cool as it looks when you zoom out and you're like, damn, that's a fun trend. Most people, they wouldn't be able to hang on to a trend like that. And that's not, doesn't make it a good thing or a bad thing. It just means that doesn't fit their personality. So they have to figure out what fits their personality. How do they get in and out of trades? I know Mercia, he's also a short-term trader. We'll have conversations, and he'll have made two trades in the middle of me like being neutral and trying to figure out my next entry. And so there's all different types of traders, and you just have to really figure out what your strategy is. I think the one thing that I can help everybody with the most is figuring out the fundamentals, the technicals, the positioning, and the background of it, and then showing which one the trends are. And so you can either get into that as well as you're moving up with things as they're whatever you think how to do that is fine. But it's more like understanding, like, I'm a very long-term trader. I'm looking at these major trends most of the time. I'm also the long-term portfolio has a lot of these major trends as well, and even more longer term than the futures. So understanding those two things, you could possibly go, okay, these things are in an uptrend. I'm going to get in and out of these things as they're going up. Same with cocoa. Like if you look at that chart, you can see that there's plenty of places to get in and out of trades in between this major trend. Same with orange juice or whatever you want to really look at. But I really suggest it's like you said, it's emotional. So figuring out what exactly is your time frame? How does that work for you? And also, how does it fit into your life? If you have kids and you're running around every single day and trying to take care of them and whatnot, and they're real young kids, it's very hard to be a day trader. But also, and the stress of like the kids and so on can make it harder for you. So maybe you might want a different time frame than that. And the same is like maybe you loved looking at the chart all day long. That would drive someone like me absolutely fucking crazy. And if you like looking at the chart all day long, you could be a day trader. So it's kind of figuring out what fits you more than anything else.
So I don't fade your trades, but when I look at some of your trades where I just don't get the fundamentals, I just avoid it. Because I mean, if I cannot intellectually make sense of something, then it's very hard to stick to that position, you know? I mean, you will have a wall adjusted stop and you'll just ride it as long as the trend is up, like the Mag 7 stocks, right? But when you know for sure that this is not sustainable, when you know the fundamentals don't support the move, how is it possible to reconcile having a position that you don't believe in and then going to sleep peacefully at night? You know, I mean, that's something that I
That's a
cannot do.
great question. I love that. So there's two things. One, I understand that I'm a trader above all else, right? Like, so as a trader, there's two different things. So as a very long-term investor, yeah, there's ideas where I'm like, hey, like maybe if today was a day I wanted to start my retirement portfolio, let's say, maybe I wouldn't want to do that today. But as a trader, I don't have faith in, let's say, the NASDAQ, for example. I don't even like the trade. I don't even like the fundamentals behind it, really. I don't like how thin the rally is. However, I do like one thing, and one thing always gives me that faith and the confidence to sleep at night. And that is my systems, my back test, my understanding of my risk management. Between those things, I can kind of go, okay, that's the way it is. And also the understanding that if my if my portfolio is set up in a different way, let's say, the Bitcoin trade recently is a good one. You know, like we had a good Bitcoin trade in the short term. We never got out of our long-term position, but then we ended up getting back into our swing position back into the Bitcoin futures. And you know, like there wasn't a lot of people had a million reasons why that could have went very badly, right? You know, like, but however, if you're trading right and you're sized properly, it's like your brain can easily tune it out because it's like, okay, that's a 1% loss in my portfolio for the possibility of a big gain. And so I think it's also time, right? So if you're doing this over time, and like I've been able to put together, and you're one of the people that I've actually shared my returns with over the years, it's like I've been able to put together, you know, like 100% years and good years. And when in the market's down, I'm still up in a strong way. Like when I'm having that and I see that over and over again, it builds confidence to be like, hey, the most important thing isn't what I'm thinking. It isn't what I believe the market will do. It's my risk management. Like, and so as long as it's my risk management, I'm going, okay, well, Bitcoin, for example, if I get stopped out, I lose 1% of my portfolio. But as it's moved up, I've made about 6% of my overall portfolio. I know the risk to reward is always high. So if you continue to just go, okay, well, the risk to reward is good, yes, like fundamentally things don't make sense, but I also know that I'm not the smartest person in the room. Not that I'm dumb, I'm a very smart guy, but I also know like I don't know what the market is seeing in the future to make it move this way. I'm not understand like at the beginning of this year, the Nasdaq trade's the easiest example. Like I'm looking at my fundamental models especially and going like there's no way in hell I want to own the Nasdaq right now. But at the time, we had rates were moving up, growth was slowing, inflation was going back and forth and wobbling around a little bit. And so we're kind of seeing that, okay, this is a really, really tough market. Like this might be a very tough market to trade. And then you get a buy signal on something like the NASDAQ and you go, shit. But at the same time, it's like, do I then override my system and say, fuck that. Like, I don't believe in this trade. Therefore, I'm not going to put the trade on.
Yeah. So here's my question here,
Mhm.
right? So you have 30 trades on. You
Mhm.
get five signals for five new positions.
Mhm.
And you know you don't want to add to your risk because you don't believe the market's going to, you know, allow you to take more risk. Then would you not just cut the trade that you just hate, that you don't believe in, even if you have a profitable position in it?
No.
Because that's what happens, right? When you are looking at fundamentals, let's say you want to buy oil, you want to buy gold, and you only have so much capital, you're going to just cut your loser in terms of fundamentals, not in terms of performance, right? You're just going to cut the position that you hate to make room for a position that, I mean, we all love the trades that we are just about to take, right? That's how it works. The old trades, you kind of start to hate them. The new ones, you're always excited and looking forward to making money on a new trade because you think you have it all figured out. So
That's
how
a
do you
good
do that?
psychological question. Because it's so there's two things. One is if you're sized the way I am, there's not many times where I'm ever sitting there and going like I have no cash left. I have to get rid of a position to raise capital. I don't really run into that problem because of the way I'm sized. So that's number one. Number two is like I absolutely so all these years I used to have that exact issue, and probably going back to 2018, I think it was. It was the palladium trade. It was right about the time I started to have the size of an account where I could trade something like palladium. And I sat there going like, hey, like I really like this is a big position. It was a big position for my account at that time. The contracts then were 200 and some $1,000. And once again, it's margin, so it's not really hurting my account because it's in futures. So I'm like, okay, maybe I'm gonna like, maybe I'll just pass this trade up, because I don't really believe in this anyways. Um, and then I said, like that was the time when I decided like I'm really going to be systematic. I'm going to stop doing stuff like that and overriding my system. So I put on the trade, and that Palladium trade was one of my best ones of the year. And then as time has moved on, and you remember in 2020 when I was getting short things and getting, shorting oil, getting long the VIX, things like that, and like somebody asked me like about the oil trade. I always get the oil trade brought up because I was one of the ones in the trade who shorted it to negative, even though Interactive Brokers closed that position. And so because of that, like I really believe now that like I don't know where my biggest winners come from ever. I really don't. It's kind of like if you start five businesses, which one is the best one? Like I can have belief, I can have conviction, I can really think something, but I really don't know until it happens. It's like when you get a job offer, same type of thing. Like if you get a job offer and you get five different job offers and it's all different companies, you don't know which one you're going to like the best. So I don't really believe that there's a way to really tell like what's going to be the thing that moves 20% and what's going to be the thing that moves 1% and what's going to be the thing that's the loser. Like I don't think we've figured out any way to really diagnose things like that. Sure, I have beliefs just like anybody else, but the biggest thing to me is just to kind of be able to put on that trade. And also, it's another thing that kind of helps me sleep at night, which is like I'm not predicting really where the market will go. I can do my analysis, I can work as hard as I can, but once the position is on, the stop is in, I'm going to walk away kind of from there. And that's just how I do it. But once again, it's kind of like there's going to be people who make money just like that, who are like, hey, like I kind of believe this over this. Um, for me, I don't think that that's conducive for me and my style.
That's a good answer. But again, like, I mean, unless you're a systems trader, that's not something that can be replicated, right? So that style only works if you're 100% convinced about your system and you stick with it.
I
Because
mean,
once
it's
you let,
it's if you talk to, I
yeah,
mean, I've had tons of interviews with all these people. If you talk to any trader, that isn't systematic. It's kind of the same thing comes up again and again, which is you don't know which one is your biggest winners. I've talked to fundamental traders or people who are just bond market traders or day traders. It's kind of the same thing over and over again. It's kind of the difference with the conviction of being an analyst compared to, like, I can talk about why the market might hit all-time highs as an analyst, but as a trader, I don't really care. Like that doesn't mean anything to me. It means how am I making money is what matters to me. So like as traders, like I've heard every type of trader, like everybody wants to kind of dice it up and go like, well, you got to be systematic to do that, or you got to be fundamental to do that. But there's the things that we have to kind of look at above everything else, which is kind of the understanding that as a trader, there's these things that all the good traders kind of inherently understand. Yes, there's the great stories, right? And you know these just as well as I do. Dudes like George Soros, they go, I know 100% that this is going to happen. And then you hear the Great British Pound short story, and everybody goes, wow, I want to do that. And then in reality, there's like 30 of those. And the 30 of those, like, there's 29 that were fucking disasters and the one that was phenomenal. And so it's like you see that kind of is the same thing over and over again. It's like, yeah, like there are people who could say they do it like this or that, but I really have never met a good trader, fundamental, technical, positioning wise, who's ever told me they make money because they know what's going to go up and they know what's going to go down. And therefore, like, that's the way they're going to do it. That doesn't mean that you have to do it like me and be like, okay, well, I'm in the NASDAQ trade and I don't really like the fundamentals behind it. I also know that it's kind of like time frames on technical charts is like sometimes the time frames don't link up and those are your best trades. But it's also sometimes the fundamentals don't link up with the technicals and those are your best trades. And there's been many years where that's just been the case over and over again. Like I couldn't have told you fundamentally why orange juice would be here or the NASDAQ would be here, but now I can tell you why orange juice is where it's at. I could tell you why cocoa is where it's at, but none of that was apparent a year ago. And also it's the difference in like if you're sized not properly, you're going to put way too much emphasis on each trade. You're going to go, okay, this trade has to work out well. Like this trade needs to work out well. I am sized to a point where like it has to work out. If it's not sized like that, it becomes a probabilities thing. And that's the thing, like all we're really trying to do, whether you're fundamental, technical, whatever, you're trying to get your probabilities correct. So if you can get your probabilities on your side and you take a swing at the trade, now that for you might be, hey, my fundamentals are this is that, this is this, and then you take that swing. For me, it's my technicals are like this, the fundamentals might be like this, but my signals are like this, and I'm going to follow my system. And for somebody who's a positioning trader, they could be also, okay, the COT looks like this, and therefore I'm going to take a swing. However, your probabilities come into play, that's the swings you have to take. So for me, my probabilities are different than yours, but that doesn't mean I have to be systematic to do what I do. Your fundamentals could be different than mine looking for something good, and that could be why you take swings at things. And just missing a trade like the NASDAQ, like it's just one trade out of a million. You might have found 20 other ones that were just as good. It's just, especially like you're in stocks, I'm in commodities. I really think it's very hard to trade commodities in a purely fundamental way. And I'm sure people can. I know there have been traders like that, but it's very hard to do that. So I trade a specific way because of it. And it helps for me, but that's just my experience. Does anybody have any other questions?
Yes, Jason. So currently you are mostly a pure trend follower? You don't apply like macro regime filters or anything to take your entry signals?
Yeah, so
Or
I do. I have macro filters. And so very similar to the things I've posted. If you look at 5 things about the market that I
Mhm.
wrote, it's one of the popular ones. And so in there, there's a thing on volatility. So I have a volatility filter that kind of helps me understand
Yes.
whether I should be in some kind of like just think of it like a band squeeze, but it's obviously it's a little bit more than that because I'm using implied vol. That'll kind of help me to understand positioning, how people are interested in the markets at the moment. I like to use the central bank filter, understanding what they're doing, mainly their probabilities into the future. When I look just directly at what's going on with the central banks, they're all over the place. They tell me all types of crazy shit. They tell all of us all types of crazy shit every day. And they really try not to surprise the market, and there's all that, sure. But the probabilities going into the future, even though they change, they kind of really give a good feel of where the market's headed. For example, this year when you had the rally in the Nasdaq and that point where it peaked out and came back, you saw the probabilities change to more rate hikes, inflation getting higher, all these things kind of changed. And as that kind of came the other direction, we started to see the market bottom and go the other way. I think that's a cool way to kind of look at that. You could build models on that. It's pretty cool. And then I really like the model of understanding inflation, growth, and monetary policy, but based on relative strength. What is the outperformer in the world based on the ASCI, which is the world index? So, what is the outperformers? Where is the money flowing to? I think that helps me to see kind of where positioning is at the time. Sometimes I can be into things like Europe. Sometimes I can be into things like commodities. Sometimes I can be into a certain currency I might find from that. The Mexican peso was from that. But just kind of looking at that or that RRG graph on stock charts is a pretty cool one too. You can kind of find all of these different areas in there. So kind of like those are the main type of filters I use. And then that kind of helps me to see how I want to be positioned. Am I thinking the
Okay.
market's in a deflationary type of market? I should be positioned one way. Do I think the market's in an inflationary environment? I should be trying to be positioned another way. However, and the Kashab and I talked about this before too, which is kind of interesting, which is, the last couple years, the one thing that has changed is that if I do start to get signals for something that isn't making sense, I do it. 2022, the yen, for example, and the bond short, those were 2 things that kind of were surprising in that year that wouldn't happen in that type of environment. So the yen was a short that doesn't usually make sense. Usually the way that works in macro is the yen is a safe haven in deflationary crises for whatever reason. It doesn't even make sense because it's a terrible currency. But literally it's kind of been falling apart for years. So like if you look at the underlying fundamentals too, and you go, okay, well, this has kind of been wanting to fall apart for years. And then you see the price signal is going short. And even though the environment's wrong, nowadays I follow it. I don't try to get stuck on like, hey, I got to do this or that. I just go which direction it's moving. If it's moving down, I'm going to short it.
Okay, okay. So you look at the macro environments, you look at the fundamentals, but at the end, the tape dictates what you do. If you go long, if you go short, it depends on the signals you get.
Yes. Yes. So it dictates like the signals, but at the same time, like I'm not one to go, okay, I cannot take this trade. I used to do that, but now I'm like, as time has moved on, I really see that that's not the way to be. Like, yes, the idea behind like the Ray Dalio style method where you're like, okay, well, I will find a few assets to trade at the same time instead of one that are highly correlated, that makes sense. Like, for example, you're in COVID, you're starting to rally in these commodities. and you're buying things like, let's say lumber, you get a buy signal in copper, you get a buy signal in even gold. And even though like maybe sometimes you go, this doesn't all make sense, you take them all anyways. That's better than being in like one trade, as in like just one that could have just sat and gone nowhere or gone the other direction. Like let's say you bought oil in March 2020, you got hammered on that. So the idea behind his idea is great. However, I just, as time has moved on, if I see that I have another position that's like going against all that and it doesn't make sense to me on the macro models, but it makes sense to me in the fundamentals and the technicals, I will absolutely take that trade.
That's really interesting. So something that I have seen this year is that some of the traders that filter out their trades based on economic data exclusively, not on intermarket analysis, but only on economic data. For example, the quad 1, 2, 3, 4 that there is a firm that uses, they have been out of all the trades that really have mattered this year, because I believe that markets are ultimately a human phenomenon, buyers and sellers, and you do not necessarily know in advance how buyers and sellers are going to interpret the data. So, for example, in the last decade and a half, whenever economic growth was slowing, equities got hammered. But for example, during this year, economic growth has been weakening, but the market is focused on inflation. So it has rallied a lot. At least the Magnificent Seven and the S&P, they have rallied a lot. So all these systems that are based solely on economic data are missing the interpretation the market has given to such economic data.
That's a great way of putting that. And I think that's something that a lot of us don't think about, right? Because especially like, for example, Hedgeye, we're talking about a brand, like their brand is this quadrant model. And I think the problem I have with it, and I've always had with Keith, is that, for example, like, okay, so he says everything he does is systematic. And yes, I do have a way of systematizing macro just like he has. However, I've noticed over the years that he overrides that shit all the time.
Okay.
He overrides that. Like, if he decides it's quad four, it's quad four. Like, if he decides that the NASDAQ, I get it. Like, the fundamentals, I didn't like him either. The breadth, I didn't like him either. But he kept saying it was in a down. Like, somebody sent me the list and they're like, is there any possible way the NASDAQ is still in a downtrend? And I mean, this is when it was like, it's over the 200-day moving average. It's hitting 52-week highs or something. I mean, there's literally no model you could make to say that the NASDAQ was in a downtrend. Now, that's okay to say, like, I don't like the NASDAQ. Like, but it's not okay to say, like, hey, the trend is in a downtrend when I'm telling my subscribers that I'm purely technical, quantitative based on at least this one thing. So, I've noticed that he does that over and over again with whatever he wants. So I notice a lot of them just kind of do what they feel over time. And I think the thing that really helps you as a trader is just to have clear criteria. And that doesn't mean you have to be technical. It doesn't mean you have to be fundamental. It just means that you have to have clear plan of like why you get in and out of trades. And if you don't feel comfortable with a trade, like that's okay. Like you don't have to look at people and say that's stupid. It's like, well, some people are making money on it. Great. I make money like this, and so there's just tons of different ways to do it. But I like the way you put that, and that's something that I think everybody can grasp from this conversation.
Yes,
Speaking of, sorry, Rafael. Speaking of hedge, I just wanted to say this. So last week they became an expert on gold miners.
Oh,
I don't
great.
know where that came from. I don't know where that came from. I mean, I do know where that came from, but it's just funny.
No, it's hilarious because it's literally like I've watched that dude for years because when he first came out, I was like, "Oh, that's cool." Like I use those type of macro models too. I read Ray Dalio's thing and there was a thing called investment clock from Merrill Lynch years and years before that that was similar. And then he was acting like he created this model, which is insane. Like he didn't create it. And then like he kept going into different things. And I think really like at this point, he's just trying to, and Kashab, you know this more than anybody in the world, as a seller of a service, he's sitting there doing this like, okay, well, what's hot right now? Okay, cool. Well, I'll be gold miners today because gold miners are hot. Gold's been up a couple days. I like gold. Now we're gold mining analysts. Like, and honestly, like, we see that so much in the industry of analysts that they just go outside their lane so much. And it's like, that's the thing with trading, as the thing BP said, it's like figuring out like, what is your lane? It's like why Kashab's question is so great. It's like, I don't know exactly if my strategy works for everybody, but I know that I try to take the big picture things from all the traders I know. That's why I like when I'm like putting out information, I'm like, this is, what the market wizards do. I'm not selling you what Jason does. I'm trying to give you guys different ideas of like what you could incorporate in your trading that are all ideas that all these types of different traders do. But I just noticed with Hedgeye in general, like it's been the biggest scam I think I've ever seen in finance, and like watching the risk range stuff and like kind of just laughing about like this dude who's like, okay, yeah, like for example, and me and uh I won't say his name, but me and another trader who I interviewed we're talking about him in the video, and we are talking about the fact that like, yeah, like if you have all the money in the world, unlimited money, and let's say you're buying the S&P 500 during COVID and it's crashing and crashing and crashing, and then you catch like a bounce and you say like, yeah, I pyramided all the way in, I caught this bounce, I got out at 0% or 0.1% gain. Like, yeah, like it sounds cool to normal people who don't trade because you're like, oh, look at that winner. I have another winner. And people who really trade know that like you don't make money by your win rate. You make money by the size of your winners or your positive expectancy. So it's like I watch him teach people these like terrible methods of trading over and over again. And I just don't know like when when people are gonna wake up and go like this dude's fucking crazy. Like, and I also had Darius Dale's service for a bit, and he like does a very similar thing, but it's completely different and it's much cleaner. Like if anybody was gonna like pay attention to somebody else's service like that, he's a good one. But it's like you're better off understanding like the picture for yourself and then building upon it, or taking someone like me and going like, okay, like I could put on these trades, do it size like this, do this way. Like you're better off doing things like that than just finding some guy that's going to tell you lies, really.
And I have seen something in these services, in these analyst services, is that they lack what I think is one of the most important traits for successful traders, and is consistency. You need to have a process that is repeatable, as you have said in many of your podcasts and interviews, that you once made a trade and your mentor told you that if you didn't know how you did it, it wasn't worth a cent because you couldn't repeat it again. And that's the problem with these types of analysts, is that they are moving from story to new story to new story based on the market narratives, and that is not a consistent process. For example, they were talking 1 year ago, 2 years ago, about the balance sheet, then they moved to the treasury general account, then to the reverse repo facility. Now they are talking about the QRA by the treasury department. So they are always moving from one story to the next, but there isn't a way to be consistent with that type of process. It is important to understand the context, economic and political, but that isn't repeatable, that isn't actionable.
Perfect. And yes, that's the thing that I just think over everything else, which is it's not about whether I trade this way or this guy trades that way or whatever, like, or how it's done. It's more like, are you able to make a repeatable process again and again and again? And
Exactly.
that's going to be the way you make money consistently. Because really, like, we're not in the business of being right. We're in the business of making money. So as we're sitting there and like, yeah, like I could sound a lot cooler if I had better hot takes or better clips of like, hot takes of what I think the market's going to do. Even I put one thing out that said the market's going to make new highs. And honestly, that was just me kind of saying the market's in an uptrend and kind of being a little bit more catchy than I usually am. And like, things like that get a lot more views than being like, hey, here's my process, but really the process is what makes the returns. And so I consistently think it's important to be able to just be able to write down your process on a piece of paper very clearly for yourself. I don't think it matters. Like I've mentioned it before, I have a friend who trades on nothing but moon patterns. He makes money. I have a friend who trades on nothing but fundamentals. He makes money. I have a friend who works for a fund and he's worked for it for many years, and you'd be incredibly surprised on his strategy. I'm not even going to get into it, but it's the shortest strategy you could ever dream of. It's so simple and it doesn't make sense why it works, but he makes money. And I see some with great win rates, some with low win rates. Nobody really over 50% win rates on their trades. And these people make money. So why do they make money? And that also always comes right back to discipline to stick to their plan, right? That's the above everything else. I could tell you why I trade, how I trade, all these things. I don't think that matters as much as I have discipline to stick to my plan over and over again. I also believe that I don't know the future. And because I don't know the future, I can't sit there and say, this trade's going to work out, this trade isn't going to work out. I'm going to just put on the trade and not think which one isn't and is. They're meeting my criteria. As long as they meet my criteria, they have a chance of working. And that's it. And then above everything else is the risk management. How disciplined am I on my risk management? Do I sometimes go, man, I really believe this trade will be better than this trade, so I'm going to put double size on this? I used to do that and it never made me any money. Ever since I really decided that, hey, I'm going to write down, and I have, and like everybody should do it on a spreadsheet, is what is the percentage of my portfolio that I'm willing to put into blank product? Am I willing to put, if I have $100,000 portfolio to make it an easy number, do I want to put $50,000 in something like Bitcoin that can stop out at 30% sometimes? No, I'm not going to do that. So maybe it's only $3,000 in something like Bitcoin. Maybe a bond is something like $10,000 because a 10% move in that bond will be, pretty 10% move in that bond is as far as that's going to go, most likely. That's the volatility of that product. So writing that all down and understanding the volatility of each product, the size that it can be in your account, all that stuff that's boring as shit that nobody wants to talk about, that's the things that make you money. The rest of it is like, I believe this my way is better than other people's. That doesn't matter. And it's a fact. And the one thing that's a fact that nobody else can ever take away from trading is that there's people have made money in this market doing all types of different things. But the one thing that's the same for consistent traders who've done it for year after year for 10, 20 years is they have a plan and they stick to that plan, and the risk management is set up in a good way.
I think Rafael was trying to talk about how analysts keep changing their uh, what they talk about, right? But that's kind of what you have to do if you have to have a job as an analyst. Because if you're not focused on what everyone else is focused on at that moment, then you're probably going to get fired and replaced with someone who is going to talk about the hot thing, right? I mean, if one of your competitors is giving a 600 price target for Nvidia and you're just sitting there thinking, no way, then you're going to get fired. You have to go along with the crowd. Whereas as traders, you don't have to go along with the crowd, right? Whatever your system is, it makes money. But as an analyst, I mean, the nail that sticks out gets hammered, right?
Yes. And nobody likes that, that for me to be a big analyst and tell people that, hey, like, yeah, I'm taking a shot at the NASDAQ. I really don't like the fundamentals, but my system's right a lot and the markets are forward looking. People don't care about that. That's not something that people go, oh, that's a good, solid idea. People think about it a different way. They go, that person doesn't know what they're talking about. And really, it's like if you talk to any trader, like they will have the same conversation with you. Like, yes, markets are forward looking. Yes, you don't know where your biggest winners come from. Yes, like, and you could do that over and over again. But as an analyst, it's a very different job. And that's why it's like, for me, I know that I post a lot of educational stuff. I don't want to just come out and throw idea after idea after idea at people because that's not real trading. And as much as like I know it would be more profitable for me to do that, I want to focus on real trading. I want to like help people to learn how to trade for themselves and be profitable. And I don't really care about being popular, but I'm also afforded that right because I am a good trader and I don't look to pull my money out of my subscribers more than anything. Like, yeah, sure, I like to make money doing this. It's fun to do this for me. I really enjoy writing and talking to everybody about trading. It's really fun for me. But at the same time, like my main primary job is to run my money and my fund and trade those things. And so as I'm doing that, I'm able to show people what this is. But granted, like there's always going to be somebody like Kathy Wood who's going to be more popular than me. And even though my returns have probably outperformed her, for years, it's still she's going to be more popular. She's has a cool idea. I mean, Kashop and I both know a guy who has a very successful newsletter, and it's been around for many years. And the whole idea behind it isn't really profitable in trading. It's shorting stocks all the time. You always have to be short stocks. You have to be long gold and long Bitcoin, and they post their returns like they bought Bitcoin the day it came out, and it makes it look like they have these crazy returns. And really, it's like if you tried to trade any way they trade, you'd lose everything year after year after year. So, but it's popular. People don't want you to say, hey, I don't know which one's going to be the biggest winner in this set of 10 trades. People want you to say, I know that Bitcoin is going to go to $100,000. And as long as it's like that, one, it's a way to be popular as an analyst. I'm not hating on it. That's what some people do, and that's their living, and they're very good at it. Um, and then, on the other end of it, I know that as a trader, I have to be nimble. I can't have any views like that because the second I start to think Bitcoin's going to hit $100,000, I'm not going to want to get out as it's coming back and hitting my sell stops, or I'm fundamentally getting a sell signal, or I'm seeing a positioning sell signal, whatever it is.
So MicroStrategy is kind of like the guy you were talking about who runs a newsletter where he just averages down on everything and then, eventually comes out ahead because, there's a bounce, there's a short bounce. And MicroStrategy, everyone looks at their strategy and think, oh, wow, he just kept buying Bitcoin all the way down, all the way up. And now they are $2 billion, $3 billion into profit. And what people don't see is the kind of stock dilution it took to get there. Right. I mean, they've been issuing so much in stock, diluting existing holders. They've been issuing convertibles in order to buy Bitcoin. And none of that matters, right? Because the price doesn't reflect it yet. and you get this cult status, this guru status, and people think, oh, if I just hold something for years and years and years, then I'll come out ahead. And I saw something very similar to this on Twitter by some guy who said macro doesn't matter, fundamentals don't matter. All that matters is you just buy the S&P and go to sleep because it makes money. And I just had to go in there and comment saying, you try that in 1965 or something, or you go try that in Japan in 91. You're not going to make anything for the next 30 years, and you're going to be absolutely miserable. But saying such cool ideas or even doing it that way, like just buying all the time, that kind of does make you look cool, especially when you're successful after a few years. And I think that's something that people really fall for, especially in the crypto community.
No, that's a great point. That's very, very well said.
And
But
I would add something, and is that the people that state that just buying the S&P and staying in the ETF forever is an investment strategy. Well, that's really kind of trend following, because what the index does is it includes the stocks that are growing by market cap and kicks out the ones that are left behind. So that's ultimately a diversified trend following strategy, which obviously has its drawdowns, like for example from year 2000 to year 2012 with zero price returns. So that's ultimately using a trend following strategy, but not accepting that you're using it.
Yes. BP, go ahead. I
No,
saw you were saying something.
yeah, I was just gonna say, so some of this is right difference in time frames, because if you're putting it for retirement and you're not touching it for 40, 50 years, like, yeah, I know there's that period where S&P was just like flat for like 15 years or whatever, right? But if you're not going to touch it for a while, then it might not matter, right? Because your time frame will be different than someone else's. But also people could be adjusting to their emotional makeup, right? Like I know there's this guy that I follow for ages back in like stock twits, and he always says this thing where like he started trading and he really made his money in when he became a VC, and he's like, it works perfect for me because I don't get shaken out of things. I'm like forced to hold because I can't like unload, my angel investment. I think like for people who like just put in the S&P and forget it, it's like, yeah, because they know if they tried to do a different strategy, their emotional makeup just doesn't allow them to be successful. At least with this, they'll get the average with no effort, other than sitting through volatility.
Yeah, but you're absolutely right, and that's something that, like, in general is correct. But talking about like the analyst community or the guru community, like that's where I think Kashop was trying to get at. If that makes sense. Am I right,
Yeah,
Kashop?
Yeah, the so-called Twitter celebrities or the media celebrities, they advocate that as a strategy, as in just buy Bitcoin, spend years and years and years buying Bitcoin, and then you will eventually become profitable, or just keep buying the S&P and you'll come out ahead in 5 years or 10 years, which is the Vanguard message, right? And what you're actually seeing is it doesn't work that way for the people who try that strategy. It may work for the people who promote the strategy, but not for the ones who try it. Like, for instance, this year, the hardship withdrawals from 401ks are at a record high or something.
Yeah.
So the strategy of just holding the S&P till retirement is not working, right? Like, it's not working for people who are forced to make actual decisions because they've been laid off, got a divorce, need to buy a house, like, pay hospital bills, like whatever is the reason. So you advocate a long-term strategy, but it's really not possible for people to stick to it for the long term.
yeah, no, I agree. I think some of it, at least for me, is education. Because I think at least my own journey, like in the beginning, I did, do the whole newsletter shop, like you follow these guys and you realize over time, like there's definitely holes in their strategy. Um, and then you start to realize, well, rather than make their mistakes, I'd rather just come up with my own strategy, make my own mistakes, improve my strategy, and kind of make it my own. Um, so I feel like a way to stay optimistic in the game, especially if you plan to play it for a really long time, is like I just try to tune a lot of these folks out because I feel like we can sit all day and poke holes in like people who aren't doing it right. And maybe their game is right, just getting fees. Like their game isn't to like outperform through investment returns.
Yep. Yep. And no, that's right because it's not about the like once again it's Hedgeye is their main just understanding the basics. Their main job is to sell subscriptions. That's what they do. I try to come from an angle where my main job is my fund, like so as long as I'm doing that, I feel like I can be more objective and just show you what my strategy is over trying to just sell you on something because that's the thing like it's sexy to say like hey like crypto forever like it's going to 100,000 soon get in before it takes off like I put money on it and I'm not I was like maybe I should do this just as a joke but I'm not going to do that but I was just going to put like $100,000 Bitcoin in Y and just make some bullshit up and I bet it'd be a really popular letter um because really people want their the trading is understanding that your beliefs are usually wrong just because you're a human. Like, and human emotion is going to put you in bad positions. And people inherently are the opposite of that. People are they want their confirmation bias media, basically. That's confirmation bias media is kind of what they look for over and over again. So they're looking for the guy that's going to tell them what they already believe. So you believe that Bitcoin's going to go up. Oh, there's this dude who's saying it's going to go to $100,000. Like everybody in the world does because, if you've looked at it over the years and you thought like $1 to 40,000, like light bulbs go off in your head and you're like, crap, I'd love to have owned that through that whole thing. And who wouldn't have? Me too. Everybody would have loved to bought it at a penny and to 40,000. And people feel like they missed out, so they have FOMO. So if you continue to kind of ride on that FOMO, that's the thing. Like even if you see like a newsletter guy who's just a person who's like, yeah, you got to buy the S&P 500, and you go all the way back to 1933, and you go like, look at this. If you'd have bought on 1933 and held to today, you made this much. Now, I'm not completely against the, buying and holding boring strategy. Like if you want to do that, for some people, they couldn't trade and make money if they wanted to anyways. So they're better off putting money into the market and walking away if they have to. Not my strategy, not something that I do, but sometimes it's something that people do. Or buying bonds for 50 years or whatever crazy stuff that I don't really like, but I understand it more than and it's better than like losing like I mean I've seen plenty of people try to create strategies and trade and lose 50% a year or 100% in months. So all of those things are possible, but I think in general when you're looking at something like a very volatile asset like something like Bitcoin and you're telling people that you're just buying on the way up and down and up and down and basically your company and Kashab you could talk about this too is these people's companies also make money like that too, where they make money when Bitcoin is going up and then everybody unsubscribes when it's going down and they subscribe when it's going back up again, and that's really like the volatility of their life at that point is all just wrapped around this one asset. And the thing is, too, is like if it's all wrapped around one asset, what if that asset actually disappears? I mean, how many crypto, I can't even tell you how many friends I had I started my fund, and I had every single friend in the world was like, "Hey, are you gonna start a crypto fund?" And I said, "No, I mean we trade crypto, but we trade futures, but we don't have a crypto fund, no." And there's everybody started crypto funds basically from that point in I think 2017 into 2022. And then when it lost money, like they were all leveraged, they had a bunch of shit coins in there. They lost everything, and they just all exploded to nothing. So it's like, I think the thing for me is like understanding like Bitcoin is interesting, but the normal person can't handle that type of volatility. They can't handle like understanding that maybe you shouldn't buy, like maybe if you don't know anything about some coin that your buddy told you about at the store, maybe you shouldn't buy it. So basically it puts a bunch of people in these really crazy positions where they don't understand it, and a lot of people just end up losing a lot of money, which sucks. I'm not saying like I can protect, like once again, like you said earlier, like we can poke holes in everybody's strategy, and that's not the way to do it. But it's like, and I can't protect everybody's money either, but watching, kind of that go on again and again, watching that people kind of gravitate towards people like that instead of someone who can like say, hey, I have a very specific strategy and this makes money over time. That's also kind of hard to watch.
So it's not just with Bitcoin, right? I mean, even with the S&P 500s, the people who are marketing the S&P 500 as a buy and hold. So Jack Schwager had another book called Market Sense and Nonsense, where he talks about the actual returns of mutual funds versus the actual returns experienced by mutual fund investors.
Mm-hmm.
And he found that there's no correlation between the two. The fund might do well and the investors won't. And that's because the time when you listen to a strategy saying buy the S&P 500 is after the S&P 500 has had a run up. Then you have 2 bad years, all these guys are out. And then you rinse and repeat, right?
Mm-hmm.
So it's not just with newsletters selling subscriptions, it's also with all the other marketing material that you don't realize is actually just propaganda, right? Like buy
Yes.
the S&P 500 or buy and hold, which is actually propaganda because no one gets those returns that those funds talk about. Like you
No.
go to the airport, you see these ads saying, had you put $10,000 in this Fidelity fund in 2013, right now you would be, like a millionaire or a centimillionaire or whatever. And then it's like, that you would never have picked that one fund. And that's the kind of deceptive marketing which the mutual fund community does. It's not just the newsletters. Like the so-called safe strategy of buying the S&P 500 is no different from the guy who is just buying Bitcoin as it goes up and down and saying, look, I averaged it out.
Yes. No, and I agree with it. It's not that I'm saying, hey, buy the S&P 500 would be great, but also it's more of like when we're talking about the idea of like any type of mutual fund or whatever, like the fees that are involved, all this stuff, like you'd be better off working for putting it in for yourself in the S&P 500 rather than doing that. That's mainly what I'm saying. I'm not saying that like you're going to get the returns, but I'm also saying that there's people in the world, like there's plenty of traders who talk about trading every single day and never make money. There's plenty of people who are out there day after day promoting a service and they don't make money. And I'm more saying like, is it safer to listen to someone like TDV over, just deciding you're going to put your money in the S&P in the SPY ETF, for example? That's more what I'm saying. Not that I like either of the ideas. I'm not a fan of either one of these things, but at the same time, that's what it is. So it's more of like we see how crazy this has all gotten with, you have if you were talking about GameStop at a certain point, you could have probably made an entire newsletter just talking about GameStop. You could people love the new hot thing. Crypto was the new hot thing. It continues to be when it's going up. It isn't when it's going down. People just really love those things. So the more as time moves on, we're kind of seeing that that's become a big trend in the analyst field where figure out what will bring everybody on, put them all into blank and go from there. And you can make money doing this, or you try to put together like a real product that makes actual money with no confirmation bias and it's different. But at the same time, it's like I know that at the end of the day, the people who call me and hire me, they're not just like I have people who are like not just and I've had this for years is I have people who are actually institutional investors who work for funds who hire me to help them and send them systems and work with them on trading and like that's incredibly important to me because that's the real people who are trading and making money. That helps me, immensely understand what I'm doing, what they're doing, and so on. But doing something where I'm like, hey, I want to bring on the most people in the world to basically lie to them and tell them that buy and hold this one or two or three assets is the only way to go. That's just not me. And, that's not you. Luckily that's nobody in here.
I think
Yeah, absolutely.
it's a matter of time frame.
Yes.
I mean, if you buy whatever Bitcoin or SPX over time, and let's say you wait for the asset to go 10, 20% down or something like that, have a little system like that. Yeah, I'm pretty sure after 10 years or 20 years or 30 years, you'll come on top and you'll be pretty good DCAing like they say, but yeah, I mean, I don't think it's a good strategy for if you look at a few days or a few weeks or a few months, I I used to listen to all kinds of gurus and letters and all that stuff. And like Jason said, at the end of the day, the most important thing is still the risk management and whatever system you put in place, either it's fundamental or technical or a mix of the two, it doesn't matter. Just take the damn trade when your signal tells you to. Use risk management, and that's it. It's really that simple. It's not that complicated. But in order to do that, it's that's where the psychology comes into, and to stay and like for example, personally, I had an amazing start of the year, and then I was following this guru, and I got short. That end of I don't know what was it, end of April, May this year, and I stayed short until we had like I don't remember, it was in August I think we got that dip, and I got out for a pretty big loss. But because I was like after 3 months or after the first 3 months, I think I was up 20%. At the end of the day, when I got out, I was down only like 5 or 10%, something like that, for the year. And since then I recovered, and I'm kind of break even, or like 5%. I'm not that much up on the year, but to come to that, it's like the only thing I've changed, because I was telling Jason that the year coming into so end of 2022 and beginning of 2023, mostly what I was doing is what I do now. It's a few days to a few weeks trades, get in, get out, sometimes in the same day, depends on what I see and what I feel. And they work fine for me, and I realized what I was doing wrong was just following some macro guru, whatever, which I kind of, I don't say I didn't agree, but it doesn't matter, the fundamentals, it doesn't matter. The thing if you mix that with your trading, that's a completely different thing. So the most important thing is when you take a trade, look at the risk management. My mistake was not to get out when I was, down 5% or whatever. If you really risk averse or something 10%, but at the end of the day, whatever system you have, get in, have a risk management, and you get out. I mean, I think from that interview you had Jason with the other Jason, the guy from Crowded Market Report or something.
Yeah, Shapiro.
That he's using a lot of COT. Yeah, Shapiro, right? He's using a lot of COT data, and he has like a 30% win rate, right? And he's been doing it for 20 years successfully. So, and yeah, that's what he says as well. You know, the most important thing is your risk management. You can be a very successful trader with 30% or 20% or whatever, but most important thing is it's how much you gain when your winners are winning compared to how much you lose, you know. And yeah, I know from my experiences that one of the hardest thing for me is to sit on my hands and to let the trend do its thing, you know. And yeah, again, it comes to psychology and to the things that you learn and you know to become a better trader. But yeah, that's all I wanted to say.
No, I get that, and that's well said. And I think that's a thing that I've noticed, with you too, is that you do have this ability now that's changed, and like I think when we start trading, part of the thing we do is like, well, we just started doing this. We don't know everything. So there's this dude who's out there who's been doing this for a long time. At least that's the way it looks to us. And so we should follow this dude because he obviously knows a lot. And really, whether that person's good or not isn't the biggest thing. It's maybe that person doesn't understand your time frame. Maybe that person is completely different from you in a different way. Maybe that person doesn't actually have any money in that trade, so it doesn't mean anything to him. So because of that, you have to have your own ideas and strategies. And part of the thing that we talked about when we first started working together was like, you were having these really good returns, you were trading really well, and you kind of got into that one. And like ever since you got out of that one, you're back to good returns, trading really well. And so I think it's, it's a lesson we all learn, right? Like it's not something that like I couldn't recognize that in you if I didn't go through that myself. I've gone through that type of shit too. We all have. Every trader has gone through bad losing periods or listening to the wrong person too much or, thinking this person knows a lot more than they really do. And then also coming with the idea that, hey, I got to create my own strategy. Hey, I got to create my own discipline above all else. Like maybe I can listen to another person's trade idea and get inspiration from it, but I have to have my own entry and exit signals, whatever that is, or ideas behind it. Understanding that we're not long-term buy and hold traders. So we're not going to just sit there in the market for 20 years and hope that it turns out well. So we're going to be traders in a different way. And so, I mean, it's the same as, I wanted to also talk about what Raphael said a long time ago. He mentioned that the certain trend followers had bad returns during certain long periods of time. Yeah, there's plenty of those, but also the important thing isn't that you look at that and go, okay, they all have bad returns, which isn't true. There's some of them, and I've only learned that in the last few years that had really good returns during those periods. I mean, Paul Mulvaney has been ripping the face off the market lately when some of them had bad returns. It's more the fact that there's long periods of time that and short periods and long that the market isn't conducive to your style of trading. And that's like incredibly important. If you're sitting there, if I'm trying to be a long-term trend follower in a very choppy market, and especially if I'm just trading like something like the S&P 500, and the market's choppy, I don't have enough assets to really make money. So if I get more assets in and I go, okay, well, the S&P is choppy, but let's say gold's going up. or bonds are going down and I can short one and be long another. Now I'm doing a little bit better. And this is why some trend followers did well, because they had a little bit more diversification, and some had worse because they didn't have any diversification. And so I think the thing that's important isn't whether strategy works all the time or doesn't work all the time. It's how do you make the market more conducive to you, and how do you understand when you shouldn't be trading? That's, I think, more important than knowing when to trade is when you shouldn't be trading, when the market's incredibly volatile, when the market's not volatile. Like, it depends on your style. If the market's in a very tight range and you're an option seller, you're going to kill it. If the market's trending in huge ways, trend followers are going to kill it. If the market is, in short-term whipsaw style trends, like a day trader or very short-term swing trader, they're going to kill it. So just understanding those things, and also the other thing of that, if you can get a little bit more on your screen, meaning not just stocks, but if you can put a little bit more on your screen, like not just stocks, you put this, that, or the other thing on your screen. Now you have some diversification to go to certain areas when stuff is crashing or changing. All right, guys, if anybody has any more questions, I'm going to hop off here in a second, get some food.
And this was really good. I think you covered everything.
Yes, Jason, this was a great time. Thank you for the space.
Thanks so much, guys. I had a blast talking with everybody. It's been
Thank
a
you,
lot of
guys.
fun. And we'll talk soon, guys. And I'm always available. So if you guys want to hit me up and just chat about whatever or trading, just hit me up, man. Like, I post my number and all types of shit on the bottom of there. So feel free to send me an email, message me. You guys know all my contacts on everything else. And also I'm probably gonna make maybe a Discord group so we can all have like little bit better of a place to talk. The Substack chat room doesn't really seem like it's that awesome. What do you guys think about that?
I didn't
Yes,
know Substack had a chat room.
I think it's a good idea because the Substack chat isn't like very user friendly. I don't know.
Yeah, I
It,
don't I
it's
don't think
kind
it
of
is.
hard to follow the threads.
Yes, exactly. And I'm honestly confused by some of them too, because I'll post like Zoom meeting, and then like I'll post another one and I'll be like, I didn't mean for that to be in a separate thread. So
Yes.
I'm gonna try to create a little bit better of a place, because I think the one thing that's always been cool, buddies that I've met and traded with for, many years, like even Kashop, like we met in a group for another newsletter many years ago. And like I think it's very cool to be able to kind of talk to other traders and have the build those types of relationships. So I'm gonna try to do something a little bit better with that. And so if anybody has any things they want to see more of, or talk more, and Marcia, we have to have a one-on-one soon too. Anybody, just feel free to hit me up.
Thank you, Jason.
All right,
Thanks,
thanks
Jason.
everybody. I'll
Like,
post this
yeah,
pretty soon.
Thank you.
All right.
thanks, Jason.
Later, Shot.
Bye,
Later,
Kashap. Bye,
Marcia,
everyone.
All right.
Raphael.
Bye.
Great seeing you guys again.
Goodbye.